Hello, everyone. I'm Noveline Brewster, Chief of Corporate Communications at the Central Bank of Barbados. Welcome to this news conference at which we will review Barbados's economic performance for 2021 and share our outlook for 2022. Good day to our journalists who join us online and all of you who are following us on our social media channels. I now hand over to Governor Haynes for a synopsis of our performance. Governor?
Thank you, Noveline. Good day and welcome to our members of the media as well as to our audience. For the second successive year, COVID-19 tested the Barbadian economy's resilience to extreme shocks. Industrialized economies rebounded strongly from the 2020 economic decline, but the persistence of the virus with its rapidly emerging variants and its after effects on the global supply chain dampened domestic economic activity, contributed to higher prices, and shaped the direction of public policy. The bank estimates that the economy registered mild growth in 2021 as new waves of infections at home and abroad slowed the recovery of the tourism sector and kept output well below pre-pandemic levels. However, for the third consecutive quarter, economic activity registered an upturn from the sharp decline the previous year. Preliminary data suggests that the fourth quarter-on-quarter recovery of 11.5% enabled economic activity to rise by 1.4% for 2021. The modest growth for the year was reflected in higher private sector spending, but the continued depressing effect of COVID-19 on the tourism sector and on private sector investment tempered the extent of the recovery. The revival of the tourism sector strengthened during the last quarter of 2021. Long-stay tourist arrivals in December were at their post-COVID peak, reaching 47% of the corresponding pre-pandemic level of 2019, as the relaxation of global travel restrictions, the phased reduction in health protocols, and pent-up demand contributed to a rebound in international travel. The steep fall in arrivals in the first quarter following the 2020 end-of-year spike in domestic COVID-19 infections, however, outweighed the gradual improved performance over the last three quarters and contributed to an overall decline for the year of 26%. Arrivals for the year were only 20% of 2019 levels. The labor market remained soft, but there was evidence of improvement towards the latter half of the year. The unemployment rate at the end of the third quarter was 12.4%, compared to 17.6% a year earlier. Improved labor demand led to a reduction in layoffs after the national pause during the first quarter. The Barbados Statistical Service estimates that over 13,000 persons gained employment in the 12-month period ending September, as the participation rate rose to 62.3%, compared to only 58.9% a year earlier. Higher incomes and increased spending boosted revenue, but government had to maintain the expansionary policy stance adopted in fiscal year 2020-21, as COVID and two unanticipated climatic events, Hurricane Elsa and the ashfall from the eruption of the La Soufriere volcano in St. Vincent, required additional spending to strengthen healthcare, protect households, facilitate rebuilding initiatives after the hurricane, and enhance the finances of the National Insurance Fund. Expectations about inflation rose as prices trended up, particularly during the second half of the year, and the global trend of rising inflation was reflected in domestic prices in 2021. The retail price index at November was 4.6% higher than at 2020 year-end, driven in large measure by higher import prices. Soaring international freight costs arising from disruptions in the global supply chain added to the hikes in energy and food prices caused by the revival of global economic activity. Domestic food prices were elevated mainly due to meats and vegetables. The ongoing weakness of tourism-related activity reduced foreign exchange earnings, even as expenditure on imports climbed. However, the stock of international reserves increased by $398 million during the year and exceeded $3 billion, a historic high at year-end. The accumulation in reserves was driven by policy-based related borrowing from the multilateral financial institutions and the proceeds of the new special drawing rights allocation by the IMF. This continued buildup of reserves over the past 42 months enabled the import reserve cover to reach 40 weeks of 2021 imports of goods and services by the end of the year. The fiscal strategy for the first 3 quarters of the year was focused on supporting the efforts of the health sector in combating COVID-19, providing assistance to individuals affected by the climatic events, and recapitalizing the NAS. The primary balance target for the fiscal year was revised from its originally planned 6% surplus to a deficit of 1% of GDP, as in the previous fiscal year. The increase in non-interest spending outweighed the improved revenue collections, and as a result, the primary surplus for the first 9 months of the fiscal year was smaller than for the corresponding period in 2020. The partial recovery in revenue was driven by the value-added tax, resulting mainly from improved business activity, higher imports, and lower refunds than for the corresponding period of the previous fiscal year. There were also modest increases in other indirect taxes, including excises, import duties, and tourism-related taxes. However, as anticipated, corporate tax revenue was lower due to the special one-off increases the previous year. The funding obtained for budget support from the multilateral financial institutions ensured the adequacy of government's financing to cope with the need to relax policy. This played a significant role in helping to stabilize what has been a difficult situation with the loss of economic activity, jobs, foreign exchange earnings, and revenues. The reliance on external funding reflects the reality that the domestic capital market has not yet returned to normalcy. The financial system remains stable as lending institutions grapple with the challenges posed by the global pandemic. During 2021, banks and credit unions continued to accumulate excess liquidity as government utilized countercyclical spending to offset the negative economic fallout from COVID-19. Credit to the household sector, particularly for mortgages and credit cards, declined, and the loan-to-deposit ratios of both banks and credit unions continued to fall. Deposit growth was slower than in 2020, and the buildup of liquidity at the central bank slowed, with the excess cash holdings of commercial banks reaching almost 27% of deposits. As a result, interest rates remain at historic lows. Turning to the outlook. Barbados' economic outlook for 2022 will continue to be heavily influenced by its vulnerability to external shocks. The IMF has forecast an increase in global economic activity of 4.4%. The extent to which tourism-dependent economies like our own are able to realize gains from this upturn will be affected by the ability of countries across the globe to control the spread of the pandemic that has caused our economy to operate well below its potential over the past 2 years. The outlook for the tourism sector looks more favorable now than it did a year ago, with the increased availability of vaccines and the reopening of economies to international travel and business activity. However, there still exists significant downside risks to travel, occasioned by the potential for the emergence of newer strains of the virus and the reimposition of travel restrictions in key source markets. Given the more favorable outlook, the bank anticipates that the improvement in economic activity witnessed over the last 9 months will accelerate in 2022. This should be driven in part by the continued revival of tourism. All indicators are for a strong, though partial, recovery in the first quarter, aided by the favorable impact of the influx of visitors for the English cricket tours, the expansion of airlift into the country, and the positive benefits of enhancements to the tourism plan. In addition, the bank is encouraged that some of the delayed medium to large-scale tourism development projects will get underway in 2022. The timing of the commencement of these investments, along with the ongoing upgrades by government to the infrastructure, including for roadworks and housing, and other small-scale private sector investments, should provide a further boost to the revival in economic activity. Positive spillovers into other sectors are expected to enable the creation of new jobs. Over the medium term, some of these investments are anticipated to open new markets, enabling sustained economic growth. The severe disruption of global supply chains has impacted the international manufacturing, transportation, and logistics sectors. Freighting costs have eased off the highs of the late last year, but prices appear likely to remain elevated, at least for the first half of the year. Oil prices, which averaged $68 per barrel in 2021, are forecast to average approximately $71 this year. But there is the risk that this forecast could be revised upwards as the world economy recovers. Sharp price increases, together with further disruptions to the supply chain, could have a negative impact, therefore, on the pace of recovery. Forecasting growth in this environment, where there is uncertainty associated with the pace of the recovery in the tourism sector, the availability and cost of international goods, and the inherent uncertainty in the execution of large-scale capital projects, remains a fraught exercise. The bank has developed multiple scenarios for growth, but is optimistic that absent the reimposition of travel restrictions or the deepening of the supply chain disruption or significant geopolitical shocks, there is potential for a robust recovery leading to double-digit growth in 2022. Undeterred by the challenges of the current climate, the government has indicated its commitment to strengthening the fiscal position while fostering sustainable economic activity through meaningful structural reforms, including improving the business environment. The primary balance for fiscal years 2020-21 and fiscal year 21-22 was modified to accommodate the increased expenditure related to support the health sector effects to fight the spread of COVID-19 and to address the damage following two natural disasters. The relaxation of fiscal targets in switching from planned surpluses to small deficits required increased borrowing. As a result, the debt stock and debt ratio rose over the past two fiscal years. As the recovery gathers momentum, government expects to again generate primary surpluses based on rising revenue and the phase-out of the extraordinary pandemic-related expenditures. The resumption of these surpluses will contain government's borrowing requirements and enable a return to a reduction in the stock of debt as new borrowings fall below debt repayments. Government remains committed to the fiscal discipline needed for the sustainability of its debt over the medium term. The adoption of fiscal rules designed to place the debt ratio on a sustainable path is critical to this commitment. We need to build on the fact that the credit rating has remained stable during this crisis, and progress towards the planned trajectory of 60% for the debt ratio will enhance the country's credit rating over the medium term, restore confidence, and facilitate access to private capital markets. The reserve buffers that we have accumulated over the past 3 years will be central to the growth of the economy over the medium term. Government's Capital Works program will assist in meeting the immediate challenge of a resumption of growth and the restoration of jobs. However, stimulating private sector activity, including through the planned investments and the acceleration of the implementation of the renewable energy program, is crucial for sustainable growth. In this regard, we welcome the focus on infrastructure within the recently announced cabinet assignments, as this has the potential to enhance the delivery of public services and contribute to diversification, innovation, and productivity within the economy. I thank you.
And thank you very much, Governor Haynes, for that update and forecast. Let me just advise the public that if you wish to participate today, you can WhatsApp us your questions at 266-8830. We now go to our media who, as I said earlier, are joining us virtually. And we start with Marlon at the Barbados Today. Marlon?
Hi, good afternoon. Good afternoon, everyone. I want to jump in on the issue of pricing. And given what you've mentioned regarding the disruption to the supply chain, I want to find out from you, Governor Haynes, is there scope at this time for government to limit, reduce, or do away with duties on freights to give the business community an ease at this time? And I have a second part to that question, not on the import prices, but the garbage, sewage, and contribution levy. And these questions are based also on what I'm hearing from the business community at this time. Can a review be done at this time in relation to the GSC levy to, with a view of slashing it, for example, especially for the agriculture sector?
Okay, so let me see if I can recall your two questions. On the first one, in terms of freight costs, I believe that within the manifesto of the administration, they did indicate their intention to hold the freight costs at the level that it was in 2019. I think I've seen numbers where it's probably about, in 2019, let's say about 4.7%, I think, of the cost of overall imports. In 2021, it rose to about 5.4% of the cost of imports. So I think that that is a measure. I've not computed what that will cost government in potential revenue, but as you would see, that it is relative to the overall cost of freight, it is only, let's say, 20% or less of the cost. So there's some revenue that government would be sacrificing from that perspective, but I think that they have made a commitment. And I think the general point that one has to make, both in relation to this and to your question on the garbage and sewage tax, is that at the end of the day, the government has to look at its overall public finances and how it's going to achieve. We spoke earlier in presentation, I spoke earlier of the need to rebuild towards primary surpluses, so that, you know, where we speak of reducing the tax, it means, therefore, that one has to find an alternative source of funding the sanitation authority. And if that alternative source comes through the public purse, then government has to look at its overall program to see where it can either raise revenues and or reduce expenditures in other areas. So theoretically, everything is possible, Marlon, but one has to look at it in the context of what impact it will have on the overall fiscal framework, and whether or not the changes that are being recommended would lead to a significant deviation away from the planned surpluses which government will need to have over the medium term in order to be able to bring that debt ratio on a declining basis. And it's not just the issue of trying to bring the debt down, but it's also ensuring that one has adequate financing to be able to meet the demands. Because I think what we sometimes miss is that each dollar of deficit effectively requires a dollar of finance. And therefore, if you're going to increase the deficit, therefore you're going to need more finance. You're going to need to borrow more. And therefore, if you don't want to borrow more, then you also have to look to see, therefore, if you can keep your fiscal balance, or if you can strengthen your fiscal position. So we shouldn't look at it solely in terms of can we do this, but rather what impact it's going to have. Now, having said that, there will be issues of, you know, if we're going to change it, let's say to impact agriculture, maybe because that is a desired objective of being able to increase agricultural activity, then somewhere else one will have to make the adjustment to compensate, whether it's through the tax itself or it's through some other measure that government will have to take.
Thank you. Sean?
Sorry, I have a quick follow-up.
Sure, go ahead, Marlon.
Yes, I got the impression from your outlook that we should not expect any lower prices, at least for the first quarter. Can you give an indication, you know, what should consumers expect as it relates to inflation?
Yeah. So from our perspective right now, what we see is that prices will remain elevated. You know, as always, some prices will go up and some will come down, but I think on average, prices will remain elevated. We indicated that the moving average ratio was about 3.2%, I think, towards the end of 2021. And based on what we've seen with how prices moved in the last half of 2021, there's likely to see that moving average inflation rate going up, and possibly even the point-to-point rate going up in the short term. Now, measures such as what you identified in terms of reducing the tax on freight costs, that will help, but it will be, I suspect, a relatively small assistance, but it will help to at least stabilize prices a little bit in the event that there's ongoing pressure from abroad. What we need to see really is for things like major items like oil, because if you look, and in our presentation, we do have a chart there which shows you the critical areas that have risen during 2021, and you will see that fundamentally transportation, which is your energy costs, electricity, which is driven by energy, and to a lesser extent food, have been the major drivers of the inflation that we have seen in the past year. When you look at it, comparing the end of one period to the end of the next period. Those are the primary drivers. So what happens to oil is going to be critical in terms of our ability to control overall inflation, because that has spillover effects into everything that we do.
Sean?
Hi, good afternoon. Thank you. Good afternoon, Governor.
Good afternoon,
I have a
Sean.
question for you in terms of the growth forecast. Recently, ahead of the election, the Ministry of Finance will publish a report, a pre-election report on the economic and fiscal situation. And in that report, it had a chart with a forecast from the Central Bank of 14.2% growth predicted for this year. You said the bank has multiple scenarios in terms of its growth forecast. So can you give us a bit of information in terms of what those scenarios entail, and if that 14.2% is a best case scenario?
Yeah, so let me answer the last question first. I would say that that's a best case scenario, the 14%. If you followed the discussion in my presentation, there are scenarios for strong growth in tourism, a strong rebound in tourism. There are scenarios for a strong pickup in construction activity. And you could get both of those happening together. And then there are scenarios where you only get a strong pickup in tourism, but we are unable to implement at a fast enough pace our investment program. There's a possibility that you could get a strong pickup in the investment program, but you don't get the same pickup in tourism. So we've done a number of these forecasts. We've done forecasts where we calibrate what if tourism increases by this percent, what if it increases by another percentage amount, in order to arrive at the different forecasts. Eventually, we have to make a sort of judgment as to which one we will go with. The point that we want to make is that in this particular environment, because there are so many unknowns, because we are recovering from such a large fall-off in economic activity in 2020 and a very modest increase in 2021, the actual forecasting has some fairly wide ranges because we are so dependent on tourism as our major economic activity. If we had a more balanced economy, then those ranges would narrow, because even if one sector was badly impacted and the others were continuing to perform, then the impact would not be as significant. And you can see in terms of, let's say, a lot of the industrialized countries which have more balanced economies, in part because of their size, et cetera, and they certainly are not as dependent on tourism, which obviously is a sector that has been badly hit during the crisis. Those economies have been able to come back much faster than tourism-dependent economies, which really require people to travel, require the interaction. The protocols, in a sense, impact persons who are traveling more than in your general, a lot of your general economic activity. So while we have not published our range of forecasts, I will agree with you that the 14% is at the upper range, but and we do feel that based on what we are seeing, what we saw in December for tourism, as I said, by December you got to almost 50% of your 2019 performance. We believe that for January we're going to be somewhere in that ballpark. The question now is, how quickly are we going to be able to get past 50%? Because we could get past 50% in November, but we could also get past 50% in March. And if we can get past 50% in March and sustain it, then that will give you a somewhat different outcome to if we have to wait until November to reach that 50%. So there are a lot of unknowns, but I hope that helps to give you a better understanding as to why we have these range of forecasts. I think our last forecast, we told you 7 to 9%. I think the IMF has said 10%. Government itself has been saying roughly about 10%. And I think there's probably a consensus coming around the 10%, but 14% is certainly within the realm of possibility if everything were to go perfectly well.
Sean, I understand you have a follow-up. Please go ahead.
Yes, thank you. Governor, well, you alluded to the importance of tourism, which we all know in terms of our economy. So therefore, what are the areas of focus you would like to have this year in terms of starting that effort to diversify the economy away from such heavy dependence on tourism?
Okay. So a lot of this obviously will have to be private sector driven. What we have to do, in my view, is that we want to strengthen our agricultural sector. We want to be able to get new investments into the country that build on the knowledge and the skills of our citizens. One of the benefits, for example, of having the international business sector over the years has been the ability to utilize the services of our professionals. And we've invested quite heavily in education over the years and produced lots of lawyers and accountants and so on. And the international business sector has been able to build on that. I think one of the strategies which certainly government has identified is now being able to build on the focus that our education has placed on sciences and being able to attract businesses which will rely, whether it's on the computer sciences, and you know that there's a lot of technology developments, fintech, etc., life sciences, to be able to utilize those types of skills which our population already has or which our population can build out over the medium term in order to be able to drive the economy. We need to get to look at foreign exchange earning sectors because obviously that is going to be important. But, one of the things that we keep harping back to is the whole question of how do we utilize renewable energy to make the overall economy more competitive so that even with traditional small-scale manufacturing and so on, we're able to enable them to be able to compete both within the region and, if possible, further abroad to be able to generate foreign exchange and to be able to generate jobs. So my perspective is that we're not going to have one big sector like tourism, but what you're going to have is a number of small sectors that are going to grow and create jobs, generate foreign exchange for the economy, but by virtue of their activities, to the extent that they are not solely dependent on tourism, it will give you that degree of diversification that will enable the economy to better respond to the types of crises that we faced over the last 2 years.
Thank you very much, Governor. And we have a question from someone who is following us online. And Governor, this person wants to know if you have any sense of whether the relationship with the IMF will continue after the program ends this year. Will the commitment to the BERT plan and fiscal targets of 6% primary balance and debt ratio target of 60% still remain after the program?
Okay, thank you, Noveline, for that question. Obviously, we have not yet sat down with the Minister of Finance to discuss in detail what we will do after the end of the program. We've had some preliminary discussions, but we've not sat down to have a detailed discussion in that regard. I think what the general public needs to understand is this is not about the IMF. This is about Barbados and putting the country on a sustainable path. Whether we do so within the framework of an IMF program, of an IMF monitored program, or we go it alone, some of the prerequisites will remain. And when I say the prerequisites, the issue which I discussed earlier of being able to finance your activities such that even if you come out of an IMF program, I don't think that persons should believe that you will suddenly start to run large deficits again. Because if you run large deficits, you have to be able to finance them. And what our recent past has told us is that as you run these deficits, you need to borrow more and more. Your debt ratios, therefore, are going to go up. That has implications for how markets respond to you. So while you may think that you want to run a 5% primary deficit, for example, if the markets are unwilling to finance you, then you get back into the situation that we were in before where we simply build arrears. So there has to be, IMF or no IMF, discipline in how we manage our fiscal affairs. And we have to manage it in such a way that we provide that confidence both to domestic and external capital markets, that such funding as we need, we will be able to get. Because, let it be clear, there will be need to borrow from time to time. The question is, how great is that borrowing requirement? And if the borrowing requirement seems to the market to be too large, then you will have challenges in being able to get the degree of financing. So I don't think the question, well, a decision will have to be made as to whether or not we go back under the umbrella of a fund program. I think the fundamental issue is how do we manage our own fiscal affairs going forward such that we are able to restore the confidence of markets in being able to deliver the goods and services which we want for our people.
Well, Governor, there seems to be a lot of interest in the fiscal related issues today. And here's a follow-up question for you from a member of the public. Should we expect fiscal tightening? Obviously, government has to now develop its budget for the coming fiscal year, determine the size of the primary balance that it will want to target. I think the important point to note is that 2 years ago, we were able to achieve fiscal surplus of 6% of GDP. And the intent was that you would do that for a couple of years. And just going back to the prior question, the 6% is not necessarily meant to be a target that you hit every year. It is just intended to be able to bring you to a certain point as you progress on the path towards that, let's say, 60% benchmark that we have set. And then once you've got yourself on that road, you're able to scale back some of those primary surpluses. You come down to 5.5, 5, 4, whatever it takes. Obviously, that's going to be driven in part by how fast the economy is growing. So when we talk about strengthening the primary balance, part of that for a growing economy is that revenue will naturally grow. So, if the economy is growing, you're buying more goods and services, more persons are working, companies become more profitable. Even without changing your tax structure, there will be improvements in your revenues. And by extension, we've had to increase our expenditure on a number of areas, including health-related. I mentioned earlier things to do with the ashfall and Hurricane Elsa and so on. As the economy improves, some of these expenditures should no longer be necessary. And therefore, you will have savings on your expenditure. You will have
growth in your revenue, and these are the things that will start to bring you back up towards stronger primary balances. There are, and I think, as you know, when the sort of work program first started, there are commitments also to strengthen the operations of our public enterprises, and therefore, in some cases, that could be, the fees that they charge, generally to improve their overall efficiency. So all of these are things that will be necessary in order to make sure that the fiscal improves in such a way that the financing requirement to manage the fiscal remains sustainable. So tightening should not automatically mean that you have to increase your tax rates, or to reduce your labor component. I think that those are the things that persons fear. Sometimes it does happen, but it's not an automatic feature once you get the economy into a growth mode. And I think that is what is critical, that we need now to be able to get back from what we've gone through over the past 2 years, to get the economy into a strong growth mode. And that is what will drive the primary balances, and we will determine what level those primary balances should be, given that over time we want to be able to set targets that will inure to the benefit of the country. And as I said, we want to move towards a 60%. We've pushed that, because of COVID, we've pushed that back to 2035, 36. So it's still somewhere, but in order to get there, you have to start a program of primary balances, of growth, and to make sure that new debt that you take on is sufficiently low cost that it doesn't, aggravate your borrowing requirement. Because one of the things that you have to recognize is that the primary balance only refers to the non-interest expenditure, but we also have to monitor the interest expenditure, because very high rates would cause that to get out of hand.
Thank you, Governor. We're going to take another question from the audience, our online audience, before we go back to the media. And Governor, this viewer is asking, what hope/prospects are there for the manufacturing sector in Barbados? What should be our focus in this regard?
Right. So I think we're also encouraging, based on our preliminary numbers, some encouraging developments with manufacturing over the past year. I think the sector is estimated to have grown by about 4%. A lot of that has been in the food and beverage area, including our well-known rum industry. And I think that what we have to be able to do in manufacturing is to really identify those areas in which we have a sort of comparative and competitive advantage. We're not going to be able to produce everything and be able to produce large scale, because we just don't have the population for it. And therefore, from my perspective, and I could be wrong, I don't think that manufacturing will be a big industry for Barbados. But there will be niches that persons are able to forage because of the sort of niche market in which they operate. I tend to think that one of the things that we have to focus on, and I mentioned earlier in terms of utilizing our skills, is to be able to look at the design aspect of manufacturing. So, you design your product, you identify it, and then somebody produces it. In some cases, we may not be able to do the production in a competitive manner, but we have to be able to utilize our skills to design. And that, I think, is going to be a critical component of what we do as we go forward, whether it's clothing, for example. So, we are not a significant clothing producer. We can't compete with the Mexicos and the Bangladeshis and the Asian countries. But can we do anything in relation to design? And I think that is an example of where we have to place some of our focus going forward, because we have creative people and we have to utilize the creativity of our citizens in order to be able to advance where the economy goes in the coming years.
Marlon and then Sean, back to the media.
Yes, thanks. Governor, I would like to know if you could give a definite timeline at this point in relation to the phasing out of the 2% tax on foreign exchange transaction.
At this time, I can't. Obviously, that is a matter for the Minister of Finance to determine. But I just would want to link it to what I said earlier. You have a stream of revenue, and once you move to remove that particular stream, you have to identify, is it that you intend to run a larger fiscal deficit or smaller surplus, whatever your situation is, or are you going to identify alternative means of replacing that particular tax? So, and at this point, without getting into discussion on the efficiency of various measures, that really is the question that you have to look at. So if you decide to take 70 to 80 million out of the system, then you have to determine whether or not you need to find something else that will generate that 70 to 80. And it could be a combination of other measures, other tax raising measures, expenditure reducing measures, or the combination thereof. It could also be linked, as I said, to the primary balance that you attempt to achieve. But at the end of the day, you have to remember that you have to be able to finance whatever deficit you decide to incur. And I think, as I said, sometimes we tend to ignore that aspect of it. Now, efficiency is important. And we're not going to go into that discussion. Efficiency is important because some taxes perhaps might not be as efficient as others, and therefore you want to remove it because it is inefficient and therefore it is hampering economic activity. And if you were to remove that, it might lead to some improvement in the overall economic activity. So you also have to take that into consideration. But the cost of the efficiency may not be as much as what you are generating from the tax. So you still need to find something else that partially recoups what you're going to be giving up once you decide to move the tax.
Sean?
Thank you. Governor, this question relates to the Treasury note which the central bank issued in November, I think it was. Mm-hmm. Will you give us an update on how the market has responded to that issue, which is the first since the domestic debt restructuring of 2018? How has the market responded, both from the institutional and individual point of view? And given that response, how much of those bonds is the central bank likely to take up?
Okay. So the bond, I think, was for $125 million. As you correctly say, it's the first that we've done since the debt restructuring. In issuing it on behalf of government, because it's really the government that is issuing the bond, we recognize that the market may not yet be fully ready to get back into those investments. And we look at who the institutional players are and were as to whether or not they would take up. So far, speaking subject to correction, we probably have had a take up maybe about 25% or so of those bonds. To date, the central bank has not taken up any, but we did indicate in the prospectus that if there's a need, then that we would be willing to take up in the context of the provision in the Central Bank Act, which allows us to take up securities of government for predefined periods, not exceeding 5 years, where a state of emergency is in place. And the presumption here is that that state of emergency creates special conditions, and I think you would agree that special conditions have been created here with COVID because of what has happened to the economic contraction and the loss of revenue, that in those circumstances we can take up securities on the primary market not exceeding 3% of GDP for a period not exceeding 5 years. But as I said, so far we have not had to do so because government has adequate financing to cover its activities, and therefore we would want to give the public that ongoing chance to be able to buy into this. There's been interest expressed. Only this week, someone from overseas wanted to know if we still had on the market. And so therefore we will leave that there until such time as we think either it's all taken up or we think that we need to intervene to buy some of those securities. The take-up, as I understand it, has been mixed. Some of it has been from other financial institutions, and some of it has been from individuals and so on. So it's been mixed. It's been low, but it's been a mixed take-up from financial institutions and individuals for the first set that was taken up by the public.
Thank you, Governor. And a member of our audience wants to find out what we at the bank are doing to regulate and reduce bank fees. Okay.
So this is a question that we have addressed on a number of occasions. And as you know, we have discussed with banks their fees. Traditionally, our role has not been to set the fees which the banks charge, but what we have done is that where we have identified charges that impact on the small and the vulnerable, we have basically, through mutual agreement, got the banks to limit the level of those fees. And what we have done in the past year is to actually publish the key fees which the banks have in order to provide information, disclosure to the public. But there are a number of things that we have said, particularly impacting the elderly as well as the young. We have set and agreed certain prices so to make sure that if you're the elderly and you go into your branch, you do not have to pay fees. We have tried to, not only tried, we have indicated to banks that they can't charge their customers for ATM transactions as well as for going into the branch. And therefore, what you would see is that if you use your own teller machine, for example, that there's no charge for using the ATM machine. The truth is that there are many charges that the banks have implemented over the years. We continue to monitor those. I know that the government has also expressed its displeasure at some of the fees that the banks are charging, and from what I can see, are prepared to put systems in place for stronger regulation of fees going forward. But as it is right now, I think what we have done is try to make sure that the fees that impact the ordinary citizen, particularly the elderly, that those persons do not suffer because of very, very high fees.
Marlon, back to you.
Yes, I have two questions. I want to put them together. Two separate issues, though. The fuel import bill, I realize that we're not making any progress in driving that down. And apart from the changing oil prices, I wanted to find out what can we attribute to this continued high cost for us. The other question has to do with the automated clearinghouse. Are we any closer to completing that?
Right. Okay. So on the question of oil, the issue has been, the prices have gone up quite significantly, and that has brought back up the amount that we are spending on oil. But I think the other aspect to it is that we have to strengthen and accelerate the implementation of our renewable energy program. And I've been assured that the government has now put in place systems, both at the level, I think, of the ministry, town country planning, as well as discussions with the Barbados Light and Power, that will facilitate a faster processing of renewable energy applications. And so therefore what we are hoping to be able to see in the near future is for there to be an increase in the penetration of renewable energy, and that increase in penetration will allow us to reduce the volume of imports of fuel so that we see precisely what you would want to be able to see. Your second question?
ACH,
the ACH. The ACH is still, upgrade is still a work in progress. Some of our banks have completed the integration, but I think some of them are also finding it difficult to get that integration completed. And I think there's a meeting only this afternoon to discuss further how we can accelerate it, because only not having all of the banks on is an impediment to what we want to be able to see. Because what do we want to see as it relates to financial services? We want to be able to generate a framework that leads to low-cost financial services. And we believe that the ACH is one of the building blocks to enable our financial institutions to be able to offer cheaper financial services than we currently have. So the first phase is complete, where I think 2 of the banks are now able to do transactions real time, but 2 is not sufficient because those 2 may not be your bank. And therefore, we need to be able to get the other banks and the credit unions. The credit unions are also working. The big credit unions are also working to be brought into the ACH. Previously, they were not. And so they're all working to be able to do that. And my hope is that within the first half of this year, we will be able to get everybody onto the real-time ACH, such that then we will be able to move from there to being able to get some cheaper financial services transactions than we have at present.
Thank you, Marlon. Sean?
Thank you. Well, I have two last questions. I'll put them together. The first one, Governor, is, well, you alluded to it in the press release, but how much of a positive impact do you anticipate that the English cricket tours to the Caribbean will have on our economy? And secondly, the government has announced that it will be introducing the fiscal rule via Parliament. How much of a role do you see that playing in terms of maintaining that fiscal discipline that you have spoken about earlier on? Okay.
So in relation to the English cricket tour, obviously, as you know, as we speak, they're preparing for the 3rd match today. Those who visited Kensington would have seen a fair spattering of English supporters over the first 2 days. Clearly, with the stadium only at half capacity, is not as much as it ordinarily would be for an English tour. But I think we're very hopeful that for the test match, that there will also be another set of English tourists. So in a sense, we've got 2 bites of the cherry. Another set of English tourists who come to watch that match, and I'm told that the numbers could be as much as 5,000 persons for the match in March. So I think that this will have a positive impact on our tourism, because on the one hand it fills rooms, but when they come they spend. And therefore, our small business sector benefits from their presence. And I can't quantify for you the exact number, but I think having them here contributes towards the earnings of foreign exchange. One of the things which we note in the press release is that with arrivals in December picking back up, that the banks through, I would say from very early in December right through the present period, have not had to come to the central bank to buy foreign exchange. So that tells you that having tourists here contributes towards our ability to earn in significant amounts of foreign exchange. At some point, somebody may have to come, but if they do, it's going to be very, very small while you have a quote-unquote booming tourism industry. And we are not nearly where we want to be. As I say, right now we are less than 50% of where we ordinarily would be. So I think that is the benefit. Now, as it relates to the fiscal rule, let it go back to what I discussed earlier. We, as a nation, have to take control of our public finances. And the fiscal rule really represents a codification of what I was discussing earlier, that we have to, exercise that discipline that will allow us to be able to finance whatever commitments we have, what commitments we have made, and therefore what the rule does and what the supporting structure, because I think the supporting structure is not just about saying that we want to get to a debt GDP ratio of 60%, but I think the idea is that we're making certain commitments, and if we deviate from those commitments, that we're able to go back to Parliament and say, well, look, we deviated because we had a pandemic. We're still committed to this process. This is how we are going to get back there because we've lost a year or we lost 2 years or what have you. So I think that is the important part. And it means that administrations going forward will have to recognize that strong public finances are a critical component of being able to generate sustainable growth for the country. Because if you don't have strong public finances and you don't have adequate financing, then, as I said earlier, what will happen is that you will go back to building arrears, or you will then end up having to take very sharp policy adjustments in order to try to bring you back from whence you came. So the fiscal framework allows you to plan for what you want to do over the medium term. And therefore, hopefully we won't have the sort of stop-starts that sometimes we've had in the past. And I think that it is a step in the right direction. How it's managed will obviously be critical, but if we keep our focus on the fact that it really is going to lend towards putting us on a sustainable growth path, then I think that over time we will all see the benefits of having had the fiscal rule.
Thank you, Sean. We're going to take this final question from the audience. Governor, should we anticipate adoption by the central bank of digital currencies and private cryptocurrencies?
I've said in the past that I think that digital currencies are probably going to come in the future. The question is when. A number of countries have started pilot tests, but I think eventually most countries will probably go that route once they've been able to iron out all of the details. And so I believe that eventually we will see a digital currency in, certainly throughout the region. Obviously, the reasons why some countries do it have different motivation to others, and therefore there's a certain urgency for some. For example, in the Bahamas, where you have all of these islands, and even in the OECS, where you're dealing with 7 or 8 countries, I can see the greater urgency for the adoption of the digital currency. But I think more generally, and the advanced economies are looking at it also. More generally, we are going to see more countries adopt the digital currency over time. We ourselves have not yet taken that decision, but it is something that we are ourselves focused on. We're looking at it and looking to see how we can have our own program, because obviously each country has a different program. We can have our own program to determine how we go forward in relation to digital currencies. Now, you know, as a central banker, we obviously separate digital currencies from the cryptocurrencies, which, you know, they carry the name currency, but they're animal of a different character, and therefore, what we are looking at as it relates to that is to having a regulatory framework that addresses issues pertaining to cryptocurrencies. But I think the fundamental one we would want to focus on is the whole issue of a digital currency, which I believe will become more common across the globe as we go forward.
Thank you. We now invite you to share your final thoughts, Governor.
Yeah, thank you, Noveline. And I want to thank the media for the questions that they have posed. They've been probing. And just to sort of summarize the broad message that we want to bring to you today, and this is really that the bank is optimistic that a robust economic recovery will start in 2022. We have a very strong reserve buffer, and we have a stable and liquid financial system to support this recovery. And as we've discussed, we have a commitment to fiscal discipline. Now, while a strong recovery requires a favorable external environment, and we talked about tourism and the international, what is happening on the international scene, we need to maximize the use of our resources, both human and financial. You know, in context of human, I spoke about the creativity, and that is something that we need to be able to utilize that creativity in order to broaden the activities in which we take place. We have to make sure that our educational systems are fit for purpose in this regard, and we have to ensure that where we have gaps, that our training systems are sufficient to be able to bring persons on board, because we have to recognize that for some things we have to provide the training. We don't all start with that knowledge and that skill, but we have to provide the training to enable persons to be able to function in the new areas that we want to see coming on stream. In addition, we need to ensure the nimble execution of our domestic policy and to ensure that all of our stakeholders are truly engaged, because only through this will we be able to improve productivity, have innovation, and to see the new investment that will drive this economy. It's not just about our own private spending, but what we will need in order to generate growth is to be able to have new investment, which will give that fillip to what we are doing. I believe that these requirements are well within our capability, but we need to move forward, and we need to do so with some agility and to do it quickly. And if we do that, then we will be able to achieve the double-digit growth that we spoke, not only for this year, but also in the medium term as we rebuild from what has been a significant loss of output over the last 2 years. So with those words, I want to thank you all and encourage you to stay safe, because the virus is still with us. Our numbers are higher than we would like, and it's important that everyone does what it takes to stay safe. Thank you.
And on behalf of all of us, thank you very much, Governor Haynes, for updating us on our country's economic performance. Thanks to all of you who joined us online, and a particular thanks to those people who took the time to pose questions, and of course to the members of the media who, as the Governor said, asked some probing questions today. Thanks again. Have a wonderful day. As Governor Haynes said, stay safe, and all the best for 2022. To the technical team, a shout out to you as usual. And of course, my colleagues in the research department. God bless you. Out of here.